Well, welcome to tonight's session. I was just reading one of my favorite books, Good Strategy, Bad Strategy. Amazing book. Let me change my camera straight on. I want to welcome everybody to tonight's session. We're going to talk about all-weather strategies, what's going on in global markets, what you should do. It's always a challenging time. We've got a lot of things going on that I'm going to try to talk about. And of course, I want you to ask questions and feel free to ask any questions about the strategies that I'm proposing and about the methodology or about other things that are going on, like interest rates or recession, stock markets, what's happening in politics. Is Trump going to be reelected or is he going to be put in jail? So many questions. So I want to welcome everybody into the group. I've been working on a new project. Actually, Tarinrat, you're very observant. This group of books has left my bookshelf. I've been working on a new project, and that I call No Book MBA. And I've identified the top 30 best business books of all time. I did this as an analyst with bottom-up data that I scraped off the internet to score and rank every single business book that I could find, about 500, until I got down to the 30 best business books. And they used to be right there on my shelf. But in fact, and hi, Peachit, nice to see you. Actually, Tarinrat, I'm going to show you where those books are. Here they are. Those are the books. Those are the 30 best business books of all time. I set myself a project to read all the ones that I hadn't read. I've read many of them, but I also went through all the other ones, and I wrote short courses on each book. And I'm creating a program called No Book MBA. And I can share more about that over time. I'm sure there's plenty of books that you've read in that, but my objective is to make it so that people don't have to read those books. Before we get started, which we'll start in just a minute, I just want to welcome everybody on. I know you've got a busy day and it's hard to make time. So I appreciate that you make time to come to this show. And I'm going to go through what we're doing with the strategies, as well as what I see coming forward. What I will summarize before I get into more detail, what I see coming forward: recession in the U.S. And unfortunately, recession in the U.S. will have a major impact on the world. So I'm here in my home studio. So just relaxing, and there's some of the books in the stack. If you are interested in that, one way of doing that is that I'm pulling this together on LinkedIn, just because it's easier for me to manage there. So I'll just share my LinkedIn profile, and if you're interested in learning about the No Book MBA, just go to my LinkedIn profile, which I just shared there, and send me a message or connect and send me a message and say you're interested in No Book MBA. I'm developing it, and I'm looking for a small number of people who are really interested to work with me as I develop it and improve it. So Best, good evening. Narit, good evening. Good evening to everyone. There's Jordan. Jordan, it has been a long time. Great to see you. Well, let's get started. We got about 80 people on, and hopefully we'll have some more coming on, but I think it's okay to get started. So I'm going to be talking about the all-weather strategies, the strategies that we have here with Phenomena, and this is my chance to kind of go into detail about what it is that we're doing. So first, remember, ask questions in the chat because I love questions, and hopefully I can answer those questions and help in that way. And our allocation strategies are global, long-term, and diversified. Those are like the core principles of what we are trying to do. So I also wanted to kind of, every time I speak, I want to talk about why we're here and what are we doing. We are here to build wealth over the long term. We're not here in these strategies to go and trade the markets and get in and out depending on what's going on. It's to try to build wealth over the long term. And we do that by first being broadly diversified, having more than one egg. And we also know that to build wealth over time, you have to contribute regularly. And then the third thing is you've got to stay invested. If you're in and out of the market all the time, sometimes you're going to call it right and it's going to seem amazing, but other times you're going to get it wrong. And that is, why we just want to stay invested over time. And that's what we're doing with these strategies, is trying to provide a strategy that will allow you to stay invested. And I also felt like it's good to start off by understanding the 12 steps to financial independence. This is the book, comes from the book I wrote. And that is number 1, create a plan and follow it. Keep investing simple. Number 2, start early because time really is money. Number 4, get real about stock market returns. Don't have extremely high expectations. Do it yourself. As best as you can, you want to do it yourself. And avoid mistakes when you're young. I know a lot of people, I have a friend of mine, he always debates me on this. He's like, you got to make your mistakes while you're young. But my point is that because of the compounding effect of money and the long-term effect on your wealth, you want to make sure that you're investing right at a young age and starting your kids at a young age and allowing it to grow. And mistakes like not investing till you're 30 or 40, huge mistakes for building wealth. And number 7, build wealth through savings. Number 8, keep financial costs low. Number 9, diversify to reduce risk. Number 10, own both stocks and bonds. Number 11, trade infrequently. And number 12, stay invested and watch it grow. Those are the 12 steps to financial independence that I have written about in my book, How to Start Building Your Wealth Investing in the Stock Market. You can get that at bookstores here in Thailand or on Amazon. And also I have an online course on that for those people that don't want to watch a book or read a book. They'd rather watch a course. But most of the principles that we're talking about in the all-weather strategies come from those 12 principles. Now, before I get into the main subject for tonight, I see Ink Prakit says, how we know if the U.S. economy is in a recession? That's a great question, and we will start to get to every single question that you guys ask. So keep asking the questions, and I'll be answering them as we go along. I'd like to start off with this chart that kind of shows the time horizon that we've been investing and proposing our strategy to Phenomena, and Phenomena's been bringing that through its advisors to you. And here we can see that our goal is to deliver steady returns over the long run. And the longest running strategy is all-weather strategy. The Alpha Focus was our second strategy, and it's been a painful time in the markets, and Alpha Focus has been down, but it is, again, long-term and trying to catch the equity upside. So that's a good one to be in when someone says, okay, I think the market's going to rise. And then the green line is the all-weather inflation guard, which is our objective with that is to target a pretty low return. We're looking at about 4% return. So with AWS, we launched it in February 2021. We target 6%. With all-weather Alpha Focus, we launched in October of 2021, and we target 8%. And with All Weather Inflation Guard, we launched in July 2022, and it targets 4%. Right now, All Weather Inflation Guard has been pretty flat because markets have been down. It's been a tough time. But those are our goals for the performance. So now let's review. From when we started All Weather Inflation Guard in July 2022, the strategies have performed almost as expected. What we can see is ranking the strategies by return shows moderate risks AWS has had the highest return, and the highest risk Alpha Focus ranks in the middle. We'd expect the opposite, right? We would expect that Alpha Focus would do better, but also remember that if markets are tough sometimes, then Alpha Focus, which is aggressive equity, can underperform. But over the long term, we've seen that it does produce pretty good performance. And of course, All Weather Inflation Guard has the lowest volatility, the green line there. That's our objective with that one. And of course, if we bring in the world equity into this chart, what we're going to see is since the start of All Weather Inflation Guard, world equity actually has done really well relative to the others. So that's over that short period of time. Over a longer period of time, we've outperformed world equity with all weather strategy. So we create our strategies for many decades. However, not even a decade is really long term. So think about it. That's a picture of me when I was a baby, and me when I arrived in Thailand, and me when I'm 100. People say when I meet them, they say, "You haven't changed." I told them that's because I went bald at an early age. So I just look old when I was younger. So our aim is to create strategies that perform over many decades. We have a great partnership with Phenomena to bring these strategies to you, and we look forward to continuing to bring these strategies. So now we're going to review the performance. All Weather Strategy was down for the month of May, 1%. All Weather Alpha Focus was down 2.7. It was a tough month. And All Weather Inflation Guard was down 0.6. So every one of the funds, the strategies was down. It was a difficult month. We're going to look at the global outlook that guides our asset allocation. So let's first go into the All Weather Strategy, which was down 1%. Remember, it's global, it's long-term, and it's diversified. So since inception, the strategy was 5.9% above a 60-40 portfolio as of the 12th June 2023. If we just look at the month of May, the strategy was 0.3% below the 60-40 portfolio, so a slight amount of underperformance in the month of May. Our 25% allocation to Japan outperformed significantly. Look at that. When we shifted into Japanese market, it was pretty much the right time, and we captured that. Of course, that's only a portion of our portfolio. We also have 25% in gold and developed Europe, which was a drag on performance. So it balances out. And here we can see that the past 1 month, the strategy was 0.7% above the 60-40 portfolio as of the 12th of June, 2023. So just looking at it on an updated basis. All right, it's time to announce our new allocations. Are you guys ready? The time has come for All Weather Strategy. Here we go. Dun, da, da, da. No change. No change. We are making no change. We're keeping equity at 65% and gold at 25%. You can say that we have a moderately defensive position, but definitely a very defensive position in the U.S. market. And for Prakit's question about the U.S. economy, the answer that I have is, first of all, that the U.S. economy is going to go into recession. And therefore, we want to be positioned for that. And that's part of the reason why we don't have a huge weighting in the U.S. Now, ARK, Mr. Cowboy says, what about the Thai baht? Well, the interesting thing about the all-weather strategies is that almost every fund that we propose in that strategy is hedging the baht against the dollar. So what that means is that you're not exposed to foreign exchange risk for much of the portfolio. So that's in terms of the portfolio. In terms of the bot, just generally talking about the bot, I would say that really the question is dollar strength. And I think we probably are going to go through a period of some dollar strength as markets get rougher and as we go into a recession. And when we have dollar strength, we'll have a weakening baht. But eventually, I believe we're going to have a much weakening dollar. And when that happens, of course, the baht, as well as other currencies, will rise. So we keep the same target allocations as we had at our previous revisions. Commodities and bonds are at a minimum 5% allocation. And we've overweight developed Europe and Japan within equity. Let's now look at the alpha focus. And remember, that's global, opportunistic, long-term, and defensive. So since inception, the strategy was 2.7% below the 60-40 portfolio as of the 12th of June, 2023. I'm not happy about that performance, but I also know that you're going to win some and you're going to lose some. And the most important thing that I've learned over the years is do not deviate from the strategy, from the methodology. And that's why I stick with the methodology, and that is our FVMR methodology. If we look at the strategy since inception, it was 2.5% above world equity as of the 12th. So yes, it has underperformed 60-40, but if somebody had just gone into equity only, they would have suffered a little bit more in the case because they were exposed only to the market. So what we're trying to do is Alpha Focus is trying to catch as much upside as we can get. So here we can see the strategy was 2% below the 60-40 portfolio, and it was 1.4% below world equity. This is for the month of May. Our tilt to Europe, small caps held up well, but our tilts to world healthcare, infrastructure, energy, and precious metals, precious metal miners did poorly. That hurt. Now, what you can see is in the past month, the strategy was 0.9% above the 60-40, and that's as of the 12th of June, 2003. And our 0.4%, we're 0.4% below world equity. So it was a good month for world equity, and we didn't capture all of that. All right, it's time to announce our new allocations for Alpha Focus. And here we can see, what do we got? We've reduced equity to 68 from 78, and we've exited world energy and increased gold. We're taking a more defensive stance. We're keeping bonds at 13%, and we're raising allocations to defensive sectors, healthcare, and infrastructure. And we've added in 3% to infotech. And we reduced miners as gold has performed better. These are the adjustments that we've made to the portfolio. And as I said, we are expecting a recession coming in the US, and therefore this is part of that positioning. Now let's look at inflation guard. Remember, it's global, it's long-term, and it's defensive. Here we can see since inception, the strategy was 2.4% below a 40% equity, 60% bond portfolio. So the strategy has experienced less volatility, but it's underperforming right now. This is a strategy, again, where we stick to our methodology, knowing that there's going to be times of underperformance and times of outperformance. The strategy has experienced less volatility. And here we can see May 2023, the strategy was 0.2% below the 60-40 portfolio, except for tips, bonds held up well. And the World Equity Fund outperformed MSCI. So remember, the World Equity Fund that we've chosen is an active fund trying to match the MSCI All Country World Index. And it started to come back a bit. Our 5% world energy allocation got hit hard. And sorry, I just go back to that for a second. You can see, whoa, too fast. Hold on. there. World energy was just painful for our performance. We had 5% allocated there, so it was painful for 5% of the performance, and part of what drove the underperformance. So the strategy was 0.4% below the 40% equity, 60% debt portfolio. And now it's time to announce our new allocations for inflation guard. And here we have keep bonds at 65%, equity at 25%, and gold at 10%. We just are making a small move, which is 5% to World Infotech from World Energy. And we moved 5% to tips from the money market. All right, let's look at the global outlook to try to answer some questions and, make sure you ask questions as I go through. So feel free to ask any questions that you want when I'm presenting, and I'll make sure to answer them at the end. So the 3-month government bond yield has risen to 5.3% from 2.5% a year ago. Central banks have been battling inflation while trying to avoid a severe recession or banking crisis. And I suspect that we're going to have those two things coming up. Expect higher rates, though at a slower pace, as central banks haven't yet got inflation down to target levels. But I would say we're probably, if I was just to, to just mention one of the themes, I've mentioned one theme, which is I expect a recession in the U.S. Happening in the next few months, starting in the next few months. And the second thing is that I think we've hit the peak of the interest rates globally. And what's going to happen now is that interest rates are going to come, they're basically going to come back down. And in fact, I think that they're going to, at some point, rush and bring those inflation rates or the interest rates down a lot when we get into the recessionary time. So now let's continue on and look at inflation. If we don't get a spike in oil, U.S. year-end 2023, inflation could be down to 3.4%, which is new normal above the old days of 2%. Now, given this backdrop of sticky inflation and high rates, we have a moderate equity allocation in our strategy. Still, in the long run, equity is the best hedge against inflation, as companies must adapt to survive. I want to reiterate for just a moment the idea about how to handle inflation. In the end, the ultimate investment asset class is equity. And the reason why it is equity is because when you invest in equity, you're investing in a CEO and a management team that is busting their butt to try to deal with the prevailing economic situation. When you buy gold, as an example, there's nobody doing anything in that case. But with businesses, they're constantly trying to adapt. And that's the reason why business generally performs over the long haul. So Radio Gaga has submitted a question about U.S. market, which I'll get to in just a bit. Now, the Fed may pause rate hikes in June. We can see that the market is pricing in an 82% probability for a pause in rate hikes at the FOMC meeting tomorrow. And the expected rate curve has actually shifted up. Remember that the curve has been coming down as people have been expecting that rates will come all the way down to 3.1%. Well, that's raised up to now 3.8 compared to May of this year. So just 1 month, and longer term rates have started to come up. The market thinks the Fed will start lowering rates by December 2023. Besides battling inflation and avoiding recession, the Fed also is trying to avoid a banking crisis. The only thing the Fed seems willing to sacrifice are U.S. jobs at this point. Now, the yield curve inversion has dived deeper, and I'm watching for that to turn. But basically, all recessions in the U.S. since 1968 were preceded by an inverted yield curve. And the average time from inversion until the recession started was about 1 year, which means we're almost there. We're almost there. Now, this is 3 months, 10-year treasuries versus 3-month treasuries. There's different ways you can measure it, but the main message is this is a sign of how what I think is coming. Keep your questions coming. I saw Kitty Porn has asked a question, and I'm going to get to that question in just a bit. Keep those questions coming. We're coming towards the end of the presentation, so then I got time to answer a lot of questions. So feel free, keep the questions coming. So we still think that central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that the central banks are going to break things. I think right now, one of the things that they've been breaking is the commercial real estate market in the US. Now, European stocks are relatively cheap. They have been out of favor for a while, and developed Europe is cheap at a PE of about 13 times and 1.8 times price to book versus the world at 16 and 2.5. So I do see that Europe has some cheap perspective there. And the PMI shows expansion in Europe. If the PMI, the Purchasing Managers Index, is above 50, it means expansion, and below 50 means contraction. And improved consumer confidence and PMI add to the attractiveness of developed Europe equity. And we have a 25% allocation in AWS. Also, Japan, there's improved profitability of Japanese companies. And while ROE has been moving sideways in the US and Europe, Japan's ROE has been trending up in the past decade. In fact, Japanese companies have been hoarding cash over the past decade. They're now sitting on $2.2 trillion in cash, and equivalent to about 44% of GDP. Now, I will just make a note about Japan. When we think about Japan, we think about debt. In particular, we think about government debt. Actually, the companies in Japan have a very high level of debt. Of cash. They are not levered up. And as I think I may have even said before, if I was a young analyst going somewhere in the world to analyze individual companies, I'd probably go to Japan, because there's thousands of companies there in the markets, and they're good quality companies, and they're sitting on a lot of cash. They have many issues with Japanese companies. I've been having a debate with someone on LinkedIn recently about Toyota. He's not happy about Toyota. And I say, I like the fact that Toyota is not following the bandwagon. All right, keep your questions coming. My goodness, let's just look at some of the questions. Chachada says, since interest rates seem to be at a peak, how do you think of investing in the U.S. Treasuries or corporate bonds? Okay, we're going to get to that. And Salaya DC, how the U.S. recession impacts world stock market and Thai stock market. Okay, good one. And Kitty Porn, how do you see recession impacts AWAF strategy through this year? Good question. And Chalum Pat says, using FER framework, what do you think about the situation of Thai and Vietnamese equities right now? And looks like this time, maybe. All right, so let's continue on. And I'm going to go back into the presentation, and we're going to go back through a couple more points, and then I'm going to get to answer those questions. High inflation in Japan means the private sector is pushed to invest. Higher inflation can lead to private investments and higher consumer spending, not to lose purchasing power. Here we can see the Japanese manufacturers turn more optimistic. We can see the PMI is turned slightly above 50, and Japan is also cheap at about 14 times PE and about 1.3 times price to book. That's compared to 16 and 2.5 times for the world. We have a 25% allocation to Japan in all-weather strategy. Now, demand for care and drugs is independent of economic conditions or cycles. I have to admit that you can see how much drugs that America pushes on people, and unfortunately, that's spreading all around the world. I've had to deal with that with my mother and try to get her off of unnecessary medications, but medical procedures that were delayed due to COVID may now drive demand. And also we're raising our allocation of world healthcare to 17% from 8% in Alpha Focus. So that's a pretty big increase there in that weighting. All right. And infrastructure is defensive. We are raising our target allocation to 17 and from 8% for Alpha Focus. And it's benefiting from government's green energy security, and other infrastructure spending. And typically predictable cash flows and are able to push through cost increases from inflation. All right. So strong momentum in Infotech. We've added 5% in Inflation Guard and 3% in Alpha Focus. Much of the year-to-date recovery in the U.S. markets and others has been driven by tech. I think the positive momentum driven by the momentum is positive driven by AI. I'm using AI or ChatGPT every single day, and I can imagine that other people are adopting it. And I know it's incredible what it's helping me do. So I'm interested, and of course, the tech companies are gaining a lot from it. Keep your questions coming. I see questions from Jordan. I see another one from KP. All right, let's talk about bonds. Bonds are typically a safe place to be, even though 2022 was exceptionally bad. In recessions, safer assets like government bonds typically have performed well, though with high inflation, low yields could still lead to negative returns on a real basis. We generally don't allocate to bonds to speculate on the upside, but rather to use it to protect capital over time. What about commodities? Well, energy prices have come down massively in Europe, as we've seen, and food prices have softened, and that's a good sign. If this trend continues, it would help to lower the pace of inflation. And then commodities have lost momentum, and we've generally gotten out of those commodities. We currently don't see a clear catalyst for energy prices to go significantly higher, and the main upside in commodities would come from a supply shock, adverse weather conditions, or significantly higher demand due to improved growth outlook. And we keep a minimum 5% allocation in AWS and no allocations in Alpha Focus and Inflation Guard. And gold. Well, central banks have been loading up on gold, maybe switching from US dollars. And I would say that gold looks strong. The recession risk remains. We keep a relatively high gold allocation in our strategies, which also serves as insurance in times of uncertainty. And in general, gold's prospect value in times of uncertainty and market downturns. It protects value, So what are the risks? Well, inflation reaccelerates. Central banks, aggressive rate hikes in QT could crash the stock markets, which I think is very possible. Poor EU and Japan markets would hit AWS. A better overall sentiment could lead to underperformance of defensive sectors. And also, if inflation reaccelerates, we could miss out on rising commodity prices. And our high gold allocation could get hit by higher rates or improved market sentiment. All right, before we get into the Q&A, remember the Valuation Masterclass Bootcamp number 10 starts on July 3rd. If you are worried about your children being home during the summer break and you feel like you got to put them somewhere to keep them busy, put them in the Valuation Masterclass Bootcamp where they can build a competitive advantage in company valuation. We have a special for everybody from Phenomena. So we still have our super early bird special available. And with Phenomena, you get an additional $100 off. So you get $100 off on any price point until June 23rd. You save about $800. You just use the coupon code Phenomena and go to valuationmasterclass.com/bootcamp, or just go to the QR code that you see there. All right. It's time for questions. So let's get into it. I'm going to go up from the bottom. So I'm going to go up this time. And Kitty Point says, what do you see recession will last long in US and EU? So I think that we're going to see a fall in the economy in the US and further bank pressure. And eventually it's going to cause a fall in the stock market. And when that happens, here's where it gets tricky, Kitty Porn. Where it gets tricky is what's going to be the reaction of the Fed. Just go back to COVID in 2020. Remember when the market crashed and everybody's like, oh my God, this market's never going to come back. And then the Fed comes in and says, we're going to buy. And next thing you know, you see the market flying up. And so it's such a difficult year in the sense that we could have a recession and the market's falling. But if we do, the Fed has the power to push the market back up. And I suspect they're going to do that. The EU also has the power to try to prevent the economy from crashing, and particularly the markets. So I think the EU will follow along with what the US is doing, which means we're going to switch to quantitative easing again. All right. Next, cha-cha-da. If Japanese stocks look interesting, why allocation in only AWS, not including in Alpha Focus? Oh, that is such a difficult question coming from you, KP. It's a hard question to answer because when we set up Alpha Focus, we set it up, we use the FVMR framework, but we set up a whole different way of thinking. We were doing kind of a barbell strategy. And that meant that what we were trying to do is have our defensive not only in bonds, but also in stocks, and then have our aggressive. And what ended up happening is that we created a whole new methodology. And the end result is that methodology, the factors under FVMR are different from the factors under FVMR of AWS. So for example, let's just say that AWS uses price, or let's say EV to EBITDA as one factor. It could be that Alpha Focus uses PE instead of EV to EBITDA. And what you may have is that it's going to give a different signal at some times. And the signal right now in Alpha Focus is not to overweight Japan. So it's a little bit of a complicated question. I think to truly answer it, you're going to have to come over for a cup of coffee, and then we're going to dig into the model, and then we can figure that out. But I don't know the answer offhand, but it's an excellent question. Jordan says, how do you see gold price in terms of other currencies other than US dollars as recession is expected to come in US? Now, basically, what I expect that we're going to see is that gold ultimately will be strengthening in a recessionary period relative to all other currencies. And we have seen, I used to have a table in here, and that table basically, used to show other currencies devaluing relative to a strong gold. And so I would say the answer to that is probably strong gold, weaker currencies, if we're looking at relative. Now, also, I'm going to go back to KP's question for just a second, because there are some things that I want to add. The first thing is that the fund universe is very different between all-weather strategy and Alpha Focus. So we have a very different universe that we're choosing from. And one of them is much wider, Alpha Focus. Also remember that in Alpha Focus, we can tilt into sectors and countries. And sometimes we may be tilting into some sectors that may be more attractive relative than Japan, as an example. So that gives you a little bit more question, but still, you're going to have to come over for a coffee. All of you are welcome. Let's do this one live next time at my house. We'll have coffee. Well, not at 7 o'clock at night, but we'll have drinks. All right. Chalon Pot says, using FEMR framework, what do you think about the situation of Thai and the Vietnamese equity markets now? Actually, right now, we're updating FVMR on a country basis across the region. And last time we looked at that, which was about 3 months ago, Thailand was neutral. In other words, we didn't have it in our ETF, country ETF portfolio. And so that tells you that kind of that Thailand was neutral. As far as Vietnam is concerned, I would say I don't have that offhand in my head, but I would say that Vietnam probably still looks unattractive right now in FVMR, or else I would be seeing it popping up. Now, before I go on to the next question, I just want to say thank you to everybody who's here. I see about 143 people on this live, and that to me is very amazing. I appreciate that you take the time. Maybe you're sitting in your car, maybe you're sitting in your bed, maybe you're sitting at your office, maybe you're sitting at your kitchen table. Like I just had my dinner with my mother. But I know you got a busy day and you've got a lot of things to think about. So I just want to thank you for attending. Keep asking your questions because I'm going up to the beginning questions and then I'm going to go back down. So keep asking your questions. I've got time and energy to answer them. Okay, Kitty Point says, how do you see the recession impacts AWAF, Alpha Focus strategy through this year? Now, this is where I said, Kitty Point, that it gets a little difficult because I think that we're going to see a recession. We're going to see the market fall, but we're also potentially going to see the Fed intervening in a pretty serious way. So that's where what I would say is the way to think about all-weather Alpha Focus, in my mind, is to say, ask yourself, do I have the risk tolerance? Do I have enough money in my portfolios and my incomes that I'm able to take a more aggressive position over the long run? If your answer to that is yes, then ultimately over the long run, Alpha Focus, that's the one that we expect because we're giving it more equity weighting. That's the one we would expect to outperform even all-weather strategy. It just so happens right now, all-weather strategy is outperforming Alpha Focus, but that should change. But as you go through a potential downturn in the market or a recession, Alpha Focus, in theory, should come down. Now, we do try to prevent massive downsides, but I think it's better to look about for the long term and think about, is the risk profile of Alpha Focus, which is basically heavier in equity, but you can still see that it's got less volatility in the market. If you think that it's still a risk profile, I would say you're going to ride it through a potential recession and down market, particularly if the Fed injects liquidity. All right, Saleh says, how does the U.S. recession impact world stock market and the Thai stock market? Badly. You know, it is going to be tough. And the thing is that let's imagine that the U.S. goes into recession. Economy is going to be struggling. That means less orders to Thai exporters that are exporting to the U.S., as an example. It also means that there's just less demand in the U.S., and that demand shift down will impact the whole world. And so we will probably go into recession in Thailand as well as many other countries. And the difference is that Thailand doesn't have the fiat currency status like Japan or like the EU, right, with the euro. So Thailand's not able to try to stimulate the market and stimulate the economy. So it can get tough for the emerging markets. I'm working on a piece right now that's related to interest rates and been looking at the impact of the U.S. rise in interest rates, and it's just massive. You know, U.S. rates are rising, but rates around the world, like in Egypt and other countries, are very, very high. And so they're getting swung back and forth. All right. Okay, Chachada says, since interest rates seem to be at a peak, how do you think of investing in U.S. Treasury or corporate bonds? In general, it should be good performance because you get good performance out of bonds when interest rates are falling. Of course, your yield is going down as you rebalance over time, but generally you get some capital gain. So I think I've answered that one. Let's see. Radio Gaga. Why is the U.S. equity market so strong while the recession seems very close and highly likely? Excellent question. And the answer to that is the U.S. market is not that strong. It's the NASDAQ and it's the top 3 to 6 tech companies that are really doing well. When you strip those companies out, the rest of the market is really starting to struggle. So that is my answer to that. So how we know if the U.S. economy is in recession? I think that technically it's not declared a recession until many, many months later when the Bureau of Economic Analysis, I think it's called, tells you it's a recession. But we're going to start seeing it as orders slow down to factories and as that type of stuff happens. I'm surprised I haven't gotten any questions about China, but I really started to really feel like China's in kind of deep trouble. And I think I mentioned last time I had some friends over from China that were coming to Thailand to start business because they felt like they just couldn't do business in China. Like China's kind of lost the business feel. Okay, Lucky says, I don't have any questions, but interested in free coffee. I think we should do a phenomena coffee lunch at my house and have some coffee and some snacks with my mom. And some of you guys have been here already at Sukhumvit 12. I know Chat Chada has, as well as some of the others. So let's do that. Yeah, Kuna Tips, you are welcome. You are welcome. Supap Bunkao says, when will you change your port in month 6? So basically today, tonight, right now is our time that we are announcing. I think it's already been announced within Phenomena, I think. We will not change the port for another 3 months. So it'll be for a while. It'll be in early September. And yes, the customers, you guys got that before. I'm just coming out now, and hopefully you've been talking to your advisors to switch into that. What about BRICS in North Asian stock market? Yeah, Prakit, I'm really worried about China. It just feels like they're having a really hard time restarting. And also, I would also say that the other thing that really concerns me about China is that there are forces in the US that are really trying to go to war with China. And one of the things that they can do is force the MSCI, the index maker, force MSCI to remove China from its index, because US investors will say, if you keep that in the index and it's 40% of the index, but then US government is giving the indication like we really are enemies with China and we don't want to invest for fear of something happening, then they're going to try to convince the index providers that China is no longer investable. And if China comes out of the indices, then it's kind of over for foreign investment in China. And you would see a jump down in Chinese market. And then it would be basically driven by the domestic players. I'm not saying that I have an insight as to when that can happen, but I just feel like that is a somewhat of a natural next step with the drum beats of war going on in the US. All right. And Supergone says, thank you to Pick Japan Fund at AWS. How do you view Japan currently? Does Japan market for at this point, because our FVMR model says stay overweight Japan in the AWS portfolio, we're keeping it there. Japan never made it into alpha focus in a big way, but in AWS, we're keeping it there for the next 3 months. So it's not yet fully valued from that perspective. Radio Gaga says, how sustainable on the AI craze rally as the number of winners are a handful? Yeah, but remember, it's the hype that we're investing in, right? Most of the time you're investing in hype. You know, the saying that we say in the market, which is buy on rumor, sell on fact. it's the rumor, it's the hype, it's the excitement that's doing that. So those are some. Do we have any other questions? All right. I think that is all the questions that we've got. Just to remind you, I got this. Oh, let's see. Hold on. The 30 books is the project I'm working on right now. I put a link into my into the chat to my LinkedIn. Just add me there and send a message and tell me that you want to learn more about it. And then I'll share more about what I'm doing there. If you've got a business or you're really trying to advance your business or advance your career, this can really help. I do see a question from Supergone who says, during rate increase period, will 60-40 still right benchmark? Can you explain more? 60-40 will be the benchmark forever, Supergone. And the reason why is because it's just the standard that everybody's used to. And if I go and change that from 60-40 to something else, people will say, wait a minute, why aren't you using 60-40? Everybody else in the world is using 60-40. So I would say that the benchmark probably won't change. And now I think what you're asking is a little bit of a different question. And that is, if you think that interest rates are going to rise, why should you own so much bonds when, you know, they're going to lose value? I think that first you have to take a long-term view. And that's one of the things that I keep saying in my presentations. And interest rates are going to rise and fall over time, and you need to have exposure. I think that the 60-40, the way I look at 60-40 is look at 110 minus your age. This is what I mentioned in my book, How to Start Building Your Wealth, Investing in the Stock Market. And that is, I look at 110 minus your age and say, that's a general guide. If you're 20 years old, 110 minus 20 equals 90. It means you should be 90% in equity, right? And as you get older, you're going to reduce that. But that gives you a picture of kind of the way that I think about the equity allocation. So I'm not sure if I've answered the question, but that's what I think you're asking. All right. Well, if there's no more questions, I'm going to say to everybody, I really appreciate you being here and taking the time out of your day. I know everybody's busy. And I do mean seriously that we should have a coffee at my house. My mom would love to meet some of you, and then we can have a lot more discussions. Maybe the Phenomena team, I know Chachida knows exactly where I live, and we can pull that together. So I want to thank everybody for joining tonight. Hopefully you learned something. Hopefully you got some questions answered about your portfolios or your allocations. And hopefully you understood about having a long-term view, having a methodology. In our case, we use FVMR, and staying the course. Everybody have a great evening. Hopefully you're home and safe. For me, it's bedtime. I go to bed so early because I wake up about 4 a.m. So I want to say good night to everybody. Thanks for taking the time. Stay invested for the long term. If you've got any questions along the way, just reach out. Have a great evening.